Why $4,000 gold is a global warning sign, not a victory. Have you ever felt a creeping sense of unease watching financial headlines? A feeling that the numbers flashing across the screen, record stock market highs, fluctuating bond yields, and now, a gold price crossing $4,000 an ounce, are telling a story that is far more complex and troubling than the simple narrative of a market rally. This isn't a moment for celebration. It's a diagnostic reading, a symptom of a deep and systemic illness within the global financial order. The celebration of such a milestone is akin to cheering a high temperature on a thermometer. It misses the point entirely. The fever is not the victory. It is the unmistakable sign that the patient is profoundly unwell. To truly understand the significance of gold reaching this valuation, we must look beyond the immediate price chart and examine the landscape in which this has occurred. This is not the result of a sudden speculative frenzy or a fleeting market panic. It is the logical conclusion of decades of policy decisions, geopolitical shifts, and a slow, grinding erosion of the very foundations upon which our modern economic world was built. The price of gold is not the story itself. The story is the debasement of every major currency, the fracturing of international alliances, and the quiet, methodical loss of faith in the promises that have underwritten global finance since the end of the Second World War. The problem we face is a crisis of trust, manifesting as a terminal illness in the post-war global order. The so-called pillars of this order are crumbling from within. Look at the United States, a nation so politically polarized that it periodically shuts down its own government, turning the basic functions of budgeting and debt management into a high-stakes political spectacle. This theater erodes credibility both at home and abroad, casting serious doubt on the long-term stability of what was once considered the world's unquestionable economic anchor. The dollar's status as the global reserve currency was built on a perception of stability and unwavering reliability, a perception that is now fading. Across the Atlantic, the situation is similarly dire, though the symptoms differ. France, once a driving force of European integration and ambition, now seems trapped in a cycle of political instability and mounting sovereign debt. The European project itself is under strain, facing economic stagnation and geopolitical pressures that its fragmented political structure is ill-equipped to handle. The United Kingdom, navigating its post-Brexit identity, has turned inward, focusing on domestic surveillance over economic production, seemingly nostalgic for a past empire while its future economic relevance becomes increasingly uncertain. These are not signs of healthy, vibrant economies, but of aging powers grappling with internal decay. Meanwhile, the geopolitical landscape is being redrawn by conflict and strategic repositioning. Russia remains embroiled in a protracted and costly war, a conflict that drains its treasury and isolates it from former economic partners. This has forced a pivot eastward, accelerating a realignment of global trade and power. China, in a masterful display of strategic patience, extends its economic and political influence across the globe. It advances its long-term goals with quiet deliberation, building new networks and dependencies while often appearing to be in retreat, a classic execution of Sun Tzu's principles, making its true intentions and strength difficult for rivals to gauge. Then there is Japan, an economic powerhouse facing a unique and deeply concerning crisis. Here we have a major developed nation where the domestic population has lost faith in both its own currency, the yen, and its government bonds. This is not a trivial matter. When a country's own citizens flee its primary financial instruments, it signals a profound breakdown of the social and economic contract. The yen, once a reliable safe haven currency in Asia, is now a source of regional instability, its devaluation exporting deflationary pressures and creating headaches for its trading partners. This internal crisis in Japan is rapidly metastasizing into a global problem. These nations, the United States, France, the United Kingdom, Russia, China, and Japan, are not minor players on the world stage. They are the permanent members of the United Nations Security Council, the supposed architects and guarantors of global order. Yet the very currencies they issue, the lifeblood of that order, have been systematically devalued by the very policies intended to project strength and maintain stability. Decades of unrestrained deficit spending, Quantitative easing and near-zero interest rates have hollowed out the purchasing power of the dollar, the euro, the pound, the yuan, and the yen. In 2025 alone, the dollar's purchasing power has been eviscerated, a decline mirrored by other major currencies. This brings us to the core of the issue. Gold has not become more valuable in a vacuum. Rather, the instruments we use to measure its value have been relentlessly debased. Gold at $4,000 is not a gold rally, it is a fiat currency collapse. The metal is simply acting as an honest measuring stick, reflecting the true extent of the monetary erosion that has taken place. When your thermometer reads 40 degrees Celsius, the thermometer's internal mechanics have not changed. It is simply and accurately reporting that the patient's condition has fundamentally and dangerously worsened. The fever is real, and its cause is the decay of paper money. The catalyst for this new chapter in our global financial story is a monumental shift in economic power from west to east. For the first time in the modern era, Asian economies are generating more wealth by trading with one another than they do by trading with Europe and North America. This is a profound and irreversible chain. They no longer require the United States dollar as an intermediary for their transactions, nor do they depend on Western consumer demand to fuel their growth. This burgeoning economic independence has cultivated a new sense of confidence and sovereignty, leading them to construct their own parallel financial architecture. A key pillar of this new architecture is the Shanghai Gold Exchange. Launched in 2019 with the explicit purpose of creating a physical gold futures market, it has rapidly evolved. By 2025, it began offering global settlement for its contracts. This is not a minor technical upgrade to a regional exchange. It is a direct and unambiguous challenge to the long-standing dominance of London and New York in the global gold market. It is a declaration of financial independence, a statement that the price of physical gold will no longer be determined solely by Western paper markets, but will be discovered in the East, where the physical metal is increasingly flowing. This Eastern accumulation of gold is a critical part of the story. While Western central bankers and academics continue to debate the monetary relevance of gold, their counterparts in China, India, Turkey, and across Asia have been quietly and consistently adding physical bullion to their reserves. The official figures, while substantial, are widely believed to understate the true scale of their acquisitions. Every ton of gold purchased by a central bank is a tangible vote of no confidence in the future of the paper-based, dollar-centric system. Each bar secured in a vault is a quiet act of rebellion against a financial order, perceived as unstable and increasingly weaponized. The core function of this Eastern gold accumulation is the rebuilding of trust, a commodity that has become dangerously scarce in the Western financial system. Trust is the invisible bedrock of all finance. For decades, it was anchored in the perceived invincibility of United States government debt. Treasury bonds were treated as the ultimate risk-free asset, the global benchmark against which all other financial risks were measured. This was the foundation of the dollar's reserve status, the promise that these instruments were as good as gold, offering safety and liquidity without question. That foundational promise is now broken. The illusion of the risk-free treasury bond cannot withstand scrutiny of the fiscal reality in Washington. A government that has spent decades borrowing far more than it produces, that engages in performative shutdowns over its own budget, and that repeatedly turns its debt ceiling into a tool for political brinkmanship can no longer credibly claim its debt is without risk. The world has watched this dysfunction and has begun to draw the logical conclusions. The largest foreign holders of U.S. debt are no longer increasing their positions. In many cases, they are actively, if quietly, reducing them. Trust is migrating away from promises that can no longer be kept. This migration of trust is not happening with a dramatic market crash or a flurry of panicked headlines. It is a slow, methodical, structural process, like water seeping through a hairline crack in a dam. And where does trust flow when it leaves the world of paper promises and political guarantees? It flows towards proof. It seeks out tangible, physical assets that exist outside the whims of politicians and central bankers. It gravitates toward the one asset that cannot be printed into oblivion, cannot be sanctioned with a keystroke, and cannot be frozen by decree. Physical gold held in allocated accounts. This structural shift is being quietly codified within the global banking system itself, through the implementation of Basel III regulations. These post-crisis rules, designed to make the banking system more resilient, have fundamentally altered the treatment of gold on bank balance sheets. Under these new international standards, physically held allocated gold, metal with no counterparty risk, is now recognized as a top-tier, zero-risk asset equivalent to cash and sovereign bonds. This is a landmark change that subtly but powerfully incentivizes banks to hold real metal, rather than paper derivatives or unallocated claims. It's a quiet re-anchoring of the financial system back towards tangible value. The implications of this regulatory change for central banks and sovereign wealth funds are profound. The Bank for International Settlements, the central bank of central banks, facilitates the use of gold in swaps and repurchase agreements. These mechanisms allow central banks to use their gold reserves to raise short-term liquidity in foreign currencies, without having to sell their bullion outright. In a world where access to dollar funding can be politicized and restricted, gold is re-emerging as the ultimate neutral collateral. As its price rises, the same quantity of reserves can be leveraged to mobilize even greater liquidity, transforming gold from a passive, inert store of value into an active and vital financial instrument. This remonetization of gold at the highest levels of the financial system is mirrored by a growing movement among individual and institutional investors. This trend has been dubbed the debasement trade, a simple yet powerful strategy: sell promises and buy permanence. It is the logical course of action when a critical mass of market participants concludes that the guarantees underpinning the system, pension promises, bond yields, currency stability, are no longer worth the paper they are printed on. This is not a fringe movement. It is a rational response to decades of monetary malpractice that has systematically eroded the purchasing power of savers. Even the most entrenched pillars of the financial establishment are now acknowledging this new reality. J.P. Morgan, a firm hardly known for promoting monetary revolution, now routinely discusses gold and even Bitcoin in the same context as legitimate hedges against the systemic decay of fiat currency credibility. The analysis has shifted from dismissal to strategic consideration. When the architects of the old system begin to recommend tools designed to protect wealth from that very system's failures, it signals a profound loss of faith from within. This is not just an observation. It is a warning from those with the clearest view of the internal machinery. Perhaps the most telling sign of this tipping point is the evolution of advice from Morgan Stanley, the very patron saint of the traditional, passive 60-40 portfolio. For decades, the simple allocation of 60% to equities and 40% to bonds was the bedrock of wealth management. That orthodoxy is now broken. Their latest guidance suggests a radical departure, recommending a portfolio of 60% equities, a mere 20% in bonds, and a full 20% allocated to striking with gold. When the high priests of passive, conventional investing start advocating for a significant holding of physical bullion, you know that the faith that underpinned the old model has completely faltered. It is crucial, however, to distinguish this shift from mere hysteria or panic. Investors are not reallocating to gold because they are anticipating an imminent apocalypse. They are doing so out of a deep-seated fatigue with delusion. They are tired of the endless charade. They have listened to central bankers promise that quantitative easing would be temporary and reversible. They have heard governments declare every deficit to be manageable and every new spending program to be an investment. And all the while, they have watched the real-world purchasing power of their savings quietly bleed away, year after year. Gold at $4,000 is not the result of panic. It is the culmination of rational disenchantment. The impact of this shift is creating a new financial landscape where traditional assumptions are being inverted. The very concept of a risk-free asset is being repriced before our eyes. For half a century, that title belonged to U.S. sovereign debt. Today, the market is asking a difficult question. How can an asset be risk-free when its issuer is the largest debtor in world history, with unfunded liabilities stretching into the hundreds of trillions and a political system incapable of fiscal discipline? The risk is no longer just a matter of interest rate fluctuations. It is a question of solvency and the long-term viability of the promise to repay. The immediate aftermath of this realization is a fundamental reassessment of value. If the promises of governments are no longer beyond question, then trust must find a new home. This is why gold's rise has been so persistent. It is not being driven by the same speculative fervor that can inflate and then burst bubbles in equity or property markets. Instead, it is a slow and deliberate monetary repricing. It is the collective global market using the only language that ultimately matters, price, to declare that the credibility of sovereign debt, the bedrock of the fiat system, is now in doubt. This is not a cyclical change, it is a secular one. This brings us to the most pressing question for anyone trying to navigate this new terrain. Is it too late? Have you missed the opportunity? The answer is an emphatic no. The fact that other asset classes have not yet experienced a catastrophic collapse is telling. Equity markets remain buoyant, floating on the remaining pools of systemic liquidity. Property markets, while showing signs of stress in certain regions, have not yet cracked on a global scale. The bond markets are bruised and battered, but are far from broken. This indicates that we are not at the end of a process, but at the very beginning of a much larger recognition event. Think of it this way: gold has not sprinted far ahead of all other assets. It has simply been the first to step out from the shadows of monetary illusion and reflect a more honest valuation based on the decay of the alternatives. You have not missed the boat. You are still standing in the harbor, watching as the tide begins to turn. The vast majority of managed money, from pension funds to insurance companies, is still overwhelmingly allocated to the traditional assets of the old regime. The great reallocation, the seismic shift of capital from paper promises to tangible stores of value, has barely begun. The takeaway from this moment is that $4,000 gold is not the destination. It is a signpost on a much longer journey. The future will not be a smooth or linear path. Monetary transitions are always volatile and contested. We can expect significant pullbacks and periods of consolidation in the gold price. Politicians will inevitably try to claim credit for any temporary dips, while decrying its rise as the work of irrational speculators. Central bankers will attempt to reassert the primacy of the old order through new policies and pronouncements, insisting that the shift is temporary and manageable. But these efforts will ultimately fail to reverse the underlying structural chain. The world is in the process of rediscovering a fundamental lesson of economic history. For money to be truly trusted, it must be anchored to something real, something with intrinsic value that exists beyond the reach of political expediency. Once this lesson is relearned by the collective consciousness of the market, it tends to stay learned for generations. The genie of monetary debasement cannot be put back into the bottle. The erosion of trust, once it reaches a critical point, becomes irreversible. The search for a reliable store of value will only intensify from here. The most sophisticated financial players are already adapting to this new reality. Central banks, particularly in the East, are continuing to diversify their reserves away from the dollar at a record pace. Sovereign wealth funds are no longer just passive investors in Western debt. They are actively allocating to physical bullion as a core strategic asset and a form of neutral collateral. Large financial institutions, which for years dismissed gold as a relic, are now reevaluating its role not just as a hedge, but as a foundational component of a resilient portfolio in an increasingly uncertain world. This adaptation is not limited to the elite echelons of global finance. Ordinary savers and investors are reaching the same conclusion. They are coming to understand that wealth held entirely in the form of promises, whether those promises are from a bank, an insurance company, or a government, is wealth that is perpetually at risk of being devalued by forces beyond their control. Owning physical gold is therefore not a speculative bet on some dystopian future. It is a pragmatic hedge against the continuing absurdity of a system that believes infinite debt can be treated as a risk-free asset forever. As one major financial news outlet recently articulated with perfect clarity, in an era of unprecedented fiscal stress and geopolitical fragmentation, The rise of gold reflects far more than just a fear of inflation. It signals a fundamental repricing of faith in money itself. It is a direct reflection of the market's dwindling belief in the competence of policymakers, the sustainability of current fiscal paths, and the very notion that anyone is truly in control of this complex and unwieldy global system. What is being repriced is not a metal. It is the credibility of the entire political and financial establishment. So as we observe gold having surpassed the $4,000 mark, we must recognize it not as an end, but as a beginning. It is the dawn of a new monetary awareness. This is not the peak of a speculative mania, but the foothills of a systemic repricing of global assets. The fundamental questions now are not about short-term price movements. The questions are about the future of money, the nature of risk, and the definition of a safe asset. The journey from here will be complex, but for those who understand the underlying forces at play, the path forward is becoming clearer every day. The transition to a new monetary order will challenge every assumption that has guided investment strategy for the past 40 years. The decline of the 60-40 portfolio is just the first casualty of this paradigm shift. As bonds lose their ability to act as a reliable hedge against equity downturns due to persistent inflation and credit risk, investors will be forced to seek out new sources of portfolio stability. Gold, as a zero-counterparty risk asset with a history of preserving purchasing power across centuries, is uniquely positioned to fill this role. Its non-correlation to both stocks and bonds makes it an essential diversifier in the turbulent environment that lies ahead. Looking forward, the actions of the world's central banks will remain a key indicator of this ongoing trend. Their continued net purchases of physical gold serve as the most powerful endorsement of the metal's renewed monetary role. These institutions are not speculating. They are making long-term strategic decisions to de-risk their balance sheets and increase their financial sovereignty. As geopolitical tensions continue to simmer, and the threat of sanctions remains a tool of foreign policy, the appeal of a neutral, universally accepted reserve asset that cannot be controlled by any single nation will only grow stronger. The central bank gold rush is not a temporary trend. It is the new standard operating procedure.